5% last week. Can this summer rally really continue, or will the weak dollar, will high oil prices and the threat of inflation bring it to a standstill? We have a bull and a bear on hand to discuss. I want to bring in here Paul Schatz, president of Heritage Capital for the Bulls, and Jim LeCamp, portfolio manager and advisor for macro portfolio advisors for the Bears. Welcome, gentlemen. Terrific to see you both. Thanks. I do want to give a little credit where credit's due here, Mr. Schatz. It was back on March 11th, right here on this program on the call, that you said this market is going to rally. In fact, you were absolutely right, so I'm going to put you to the test again. What do you say? Do you think this is a rally that's going to continue?
On balance, I do. I think my first target was 9,000, which we hit just last week, and I think on balance we're probably going to somewhere in the 10,000 area in the next 2 to 3, 4 months, certainly this year, before any kind of trouble hits.
Well, what's going to get us there, Paul?
Well, listen, my song has been the same. I'm not that smart, so I'll keep it simple. Liquidities drove this market from the March lows. Liquidity continues to drive this market until the Fed really pulls the punch bowl, which I think they're going to do, 3 to 6 months down the road. But until that point comes, money's still going to flow into equities and commodities and everything else.
Yeah, but there's a lot of money still on the sidelines. I mean, is that going to be, do you think, coming in and really helping things? I mean, we look at the Treasury market. There is some concern there because you got $200 billion coming to market this week. What's all that money that's out there right now going to do, Paul?
That's the only argument that somewhat bothers me, is that there's so much money in the sidelines, therefore it somehow has to come in. But if you look over history, there's always trillions of dollars in money markets, and I think it's kind of silly to believe that money somehow has to come in. A lot of that money is never coming into equities. There's a certain amount, sure, but the vast majority is not. The key for me is money is cheap and it's easy, and that's why money will flow into stocks, not because there's so much on the sidelines.
Larry, you want to get in there? I'll give you dibs on our bear with Jim.
I want to come to my great pal, Jim LeCamp, who I love dearly, but has missed this little summer rally. Mr. LeCamp, big story in the Wall Street Journal today. Corporate bonds really roaring ahead. And now with corporate bond prices up and rates down, the difference against Treasury has narrowed by 50%, pointing to pre-Lehman levels in the summer of 2008, roughly 1 year ago. Why shouldn't the stock market get to pre-Lehman, which would be about 1,200?
Well, there's a reason the stock market won't get to the pre-Lehman level, because consumers won't be spending the amount of money that they were back then. Businesses won't be spending the amount of money that they were back in, and credit has actually narrowed. It hasn't expanded. And while we believe that this is a bear market rally,
credit quality, the only reason I raise it from corporate bonds, corporate bonds are telling you that credit quality is improving for business, and that the outlook for profits, which is the prime determinant of credit quality, just like stocks, that's doing better too. So I just want to know, isn't there a link between the rally in corporate bonds and the stock market, and doesn't it say we're going higher?
Absolutely, and I think we are going higher. I think this market could go to 10, maybe even 11,000. But I still believe it's a bear market rally, or at least a pit bull market rally, in that it could turn and bite you and maul you at any minute.
Okay.
And the reason is it all boils.
I'm sorry, Jim. I gotta interrupt you right there, because we've got some breaking news, some really interesting comments from you. We'll get back to you later. Let's go to Rick Santelli.
Well, we just had